Well, as you know, the SEC officially gave the big green light to Project Crypto. Lots of changes are coming on board, and Wall Street is already popping the champagne, of course. But before you think that this is 100% bullish on Bitcoin, cryptocurrency, Ethereum, let me show you two risks that no one is pricing in yet. So if you've got money in Bitcoin, Ethereum, altcoins, MicroStrategy, crypto ETF, this directly impacts you. So the two risks that no one is pricing in has to do with institutionalization, the big word, and spillover. So I don't need to tell you that the investment landscape is changing very rapidly, and these changes are going to affect your financial future. So you want to make sure you stay informed, click the like button, and subscribe to this channel. And well, let's get started. So the first risk has to do with institutional investors coming into crypto. They've been here for a while already, but this is going to be scaling it up and multiplying their impact. Here I'm looking at the SEC's speech from Paul Atkins in July 2025. I've already had another detailed review of this report, but I just want to highlight a couple of points here. So, onshoring of crypto. So this is what the Project Crypto is going to be, involving a number of different initiatives across the SEC and the CFTC. And one of the key priority is to establish a regulatory framework for distributions of crypto assets in America. Basically, making everything legitimate in terms of being able to invest in cryptocurrencies, in altcoins, etc. So despite the SEC, what the SEC has said in the past, most crypto assets are not security. So I'm not going to go over everything because I've already gone through all of that. But he has directed the Commission staff to work to develop clear guidelines that market participants can use to determine whether it's a crypto asset is a security or subject to an investment contract. And basically, they want to make sure that all the institutional investors, the broker dealers, all these people get access and get their piece of cake when it comes to crypto. So one of those things, it has to do with those crypto asset transactions are subject to securities laws. I've asked staff to propose purpose-fit disclosure, exemptions, safe harbors, etc., to just make it easier to formalize a way to bring in these crypto projects online and have people actually trade on them. Additionally, many firms, they seek to tokenize their common stocks, their bonds, partnership interests, other securities. We talked about real estate also, and basically being able to exchange that and tokenize these securities and then being able to exchange that in some kind of exchange, either an SEC exchange or some non-SEC exchanges. The other aspect of the institution as well has to do with the custodians, making it easy for people that own tokens to actually give the custody of these tokens to their broker dealer so that they can do these the transactions or the investment a little bit easier, maybe even a little bit faster. That custodian's taking control of your tokens. And so this is a big shift from when we talk about self-custody of your tokens. Now, a lot more people are going to give the custody of their tokens to a broker dealer, to an investment bank, and that makes a big, big difference. I'm going to stop here for that on the SEC, but really on the surface, this is great. I mean, it looks like the SEC is adopting crypto. Institutional investors, broker dealers are going to be able to trade those and hold those for their investors, and that means also more money that's going to flow into the system. But here's the reality, is that when Bitcoin is funneled into these ETFs, once it is sent and under the custody of your broker dealer, of your JP Morgan, or of you no longer control the cryptocurrency, that Bitcoin or whatever you have. So now the custodians have control. So now instead of having thousands of people that are holding their own keys. Now you have the BlackRock, the Fidelity, the Vanguard. You have also, like JP Morgan will hold a massive amounts of these Bitcoins. So what they can do, they normally kind of trade. If you have an account, for example, that a margin account with Schwab or with Fidelity, whatever, they have control of your tokens and they can do things with your tokens. They can lend on your tokens. They can do options on your tokens without your approval, because that's kind of part of the agreement with the margin call. So if they lend it out or they lock it up, you don't have a choice. You can't say, well, I don't want to do that, because you have a margin account, you sign something with them, so they now have control of your Bitcoins or your cryptocurrency. So you thought you own, Bitcoin or whatever, but really now what you have, you've passed your Bitcoin to your broker dealer, to your institutional bank or your fund, and now you don't own Bitcoin, you own a claim to your Bitcoin, which is very, very different. So imagine you own $1 million worth of Bitcoin in a Fidelity like 401k account, you have a self-directed or something. So you don't hold the private key, right? So you don't really control that cryptocurrency. And if Fidelity decide to participate in a lending program, so your Bitcoin could be loaned out without you having to say, no, I don't want to do that, or approve that. So in a crisis, you may discover that you want to take your Bitcoin out, but let's say the Bitcoin is some kind of crash or something like that, then you may discover that you don't actually have the liquidity or the ability to liquidate your position in Bitcoin. This is a little bit kind of like a run on bank, but a run on your Bitcoin. If you have the custody of your Bitcoin in your wallet, this is very different. You can do whatever you want at that point. You control what you do with this. This is what kind of happens here. The custody is something that's very important. The other thing too is that a lot of these broker dealers are going to want to do both. They're going to want to do the stock market, they're going to want to do the cryptocurrency, and they want to bring all of that together. So a broker dealer with an alternative trading system, the SEC wants them to be able to trade non-security, non-sec crypto assets alongside crypto asset security. So they want to be able to bring both of these things and be able to play in both fields. They want to make it super easy for an institutional bank or a fund to be able to do both under one umbrella and not having to have so many licenses in order to do that. It's going to create more direct correlation with equities. We're already seeing that in the stock market. Bitcoin is often described as kind of a digital gold, but with the correlation between the stock market and Bitcoin has grown closer and closer. So let me show you a couple of articles that I've seen. So Bitcoin's original appeal, this is about the volatility. We'll talk about that later. This one is about Bitcoin is not the new gold. So given its stability in times of crisis, gold is an ideal investment to diversify a stock-heavy portfolio and to hedge against the risk associated with being heavily invested in the stock market. Now, Bitcoin, on the other hand, has been extremely volatile in recent years, and more importantly, its performance has been linked to that of the stock market. So Bitcoin has shown a high correlation with the stock market return since 2015, meaning that, unlike gold, it tends to move in the same direction as the stock markets. So while gold was found to have a weak negative correlation with the S&P 500, Bitcoin's price was found to be strongly correlated with the stock market. And in fact, often people are using Bitcoin to kind of accelerate their gains because it goes in the same direction as the stock market, but kind of amplifies the effect of the stock market. So this is kind of that one article here. And I have another article just in case you don't believe me, that talks about also why Bitcoin's relationship with equities has changed. So in its early years, Bitcoin was considered a diversifier in the portfolio, often compared to digital gold, even thought of as an inflation hedge. In 2020, a significant shift occurred. The relationship between Bitcoin and equities turned positive and has remained so over the past 5 years. So daily returns data from January 2014 to April 25 reveal a correlation of 0.2% between Bitcoin majority and major equity indices. However, when examined in smaller time frames, the relationship between them becomes more pronounced. In 2020, for example, the correlation between Bitcoin and the S&P 500 and the NASDAQ 100 indices shifted from being non-correlated to a positive relationship, with rolling correlation jumping to 0.5. Right? So the positive correlation is not limited to single index, and the trend is widespread. So higher positive correlations are frequently observed during periods of market stress. So basically, that when the stock market is stressed, people tend to use crypto and invest at that time as well. So there are 5 seemingly common factors between equities and Bitcoin that may be contributing to this positive correlation. One of them is institutional acceptance. So as we have more institutions and institutional investors that are going to come into crypto, that means that this effect is going to be amplified. So that means, even more correlations. Portfolio integration. As more users integrate crypto into their portfolio, we just talked about the broker dealers being able to do trades both on cryptos and stock market and non-cryptos. So then you're going to be logging into your account at Schwab or whatever, and you're going to be able to do the trade on both crypto and non-crypto assets, and SEC and non-SEC asset. The other one is high volatility. So Bitcoin's daily standard deviation is roughly 3 to 5 times higher than that of equities. So this high volatility suggests that Bitcoin may now serve as a beta extension of a portfolio equity. That means that since it's going in the same direction, and I know that the stock market is going in this direction, I'm going to invest in stock, but I'm also going to invest in crypto or Bitcoin, so that it would accelerate, because the Bitcoin is going like 3 or 5 times faster or stronger than the stock market. I'm just going to put some money in the Bitcoin, and it's going to go in the same direction, but it's going to multiply the return with a small bet. So this is what it means here. Supply and holding patterns. So the reduction in Bitcoin supply held at exchanges. So concurrent rises, and the concurrent rise in supply held by other entities such as institutional investors and long-term holders indicates a maturing market. This shift in supply dynamics can influence price movement and correlation. So they're going to be much more holder of these Bitcoins, and that's going to be, again, if the stock market goes down, they may decide to pull or pull out of crypto and stuff like that. But in general, the supply and holding patterns are similar to the stock market. And finally, increased access. So the rise of the ETF futures and option has made it easier for investors to access and trade cryptocurrencies. Right? So because of that, it's as easy now to invest in crypto as it is to invest in the stock market. Then people are going to do more of that. So the correlation, basically is there. Once it's managed by a portfolio manager, it starts to trading just like another tech stock, basically. And that's what we're seeing. We're seeing more correlations with tech stock in NASDAQ and S&P 500. That means that when the S&P crashes, your Bitcoin portfolio is also going to crash, and it's going to crash faster than the stock market. So it's not because Bitcoin failed, but because Wall Street sold it to cover losses somewhere else. So a lot of these institutional investors are not so stuck on holding their position. They want to make sure that they maximize return and they protect their investments, their investors. So they're going to go and close their position on crypto in order to protect their returns. Then we have the whole aspect of synthetic supply and price suppressions. So if you look at the gold market, for example, so banks created like a lot of like paper gold. I mean, if you look at COMEX, for example, all the futures contracts and all that, And so these are basically, it's not really the true price of gold. What you're seeing on these is the future prices of gold, these futures contract, what they think the gold price is going to be in the future, and then they trade on that. And the volume of trading is significantly higher. The value of these, the paper gold is much bigger than gold itself, which is kind of mind-boggling. But the effect of that is really kind of a smoothing of the gold prices, and they're going to do the same thing with crypto. They're already doing it with crypto, and so if that happens, so BlackRock, for example, knows that $1 trillion in 401k is flowing in, and then they could create a synthetic exposure through a future or option or derivatives of some sort, and then that would basically kind of slow down and cap the that rocket from coming in, because they're going to take advantage of that, and it's going to taper that curve. So that's kind of like the idea there. Obviously there's a lot of different dynamic effect that could happen there, but this is really something that to look at. Now, because of that correlation, definitely expecting some kind of spillover, which is my risk number 2, because there's so much more connection now with crypto and the stock market because of the institutional investors and all of that, but also because we have companies that are Bitcoin treasuries or crypto treasuries. So these companies are going to be, they're tied in with the stock market and with the crypto. The more you connect the crypto into the regular financial plumbing, like stocks, bonds, pension plans, and stuff like that, we could be setting ourselves up for major financial crisis like we've seen in 2008, when we basically had issues with the mortgage market, and that ended up affecting the stock market. Now we can have the stock market affect the Bitcoin market, or we can have the other way around, have the Bitcoin or crypto market affect the stock market one way or another. But because they're connected, there's going to be a connection. Unfortunately, a lot of people don't believe that there's a connection, and this is kind of the fallacy, and the issue here is that people need to be aware that there's a stronger and stronger connection between crypto and the stock market, so that they can be prepared for that. We're going to end up with tokenizing security and more complex products like options, etc. So, for example, JP Morgan is exploring plans to offer loans secured by clients' Bitcoins and Ethereum, and that would be rolling out like next year. We also have UBC, HSBC, Goldman Sachs offering tokenized bonds. These institutional investors, these guys, they really like to use as much leverage as possible. They'd like to do all kinds of derivatives of existing assets, so they can accelerate their return and maximize their return. But also the issue with that is this could be some concern that if something blows up, then it's going to blow everything else up. Remember GameStop, remember AMC, remember a couple of other situations like that. And now it's going to be open to the world, not just the United States and the few players that are on Red Robin. It's going to be everybody around the world that's going to have access to that. Then, so leverage, futures, options, ETFs that are already 10x leverage, these are already in existence, and they tend to amplify these moves. If there's a 15% drop in Bitcoin, that could also trigger liquidations in other stocks, other ETFs, and that could wipe 25% off the market, the quote-unquote real market. So even if you're a conservative holder, your $1 million portfolio could potentially lose like $250K because of that drop in the market. So that's part of it. Then there's contagion risk also. This is kind of the other spillover when you have like pension funds or other institutions that are piling into crypto-backed products. So if the pension takes a huge loss in something, then they're going to try to recapture and this loss somewhere else. So they might have to sell some bitcoins or some other assets in order to cover that loss, and then that could cause bitcoins or other assets to drop like 20-25% overnight. And again, not because Bitcoin broke, but because the financial system around it did. So who wins in this SEC backed crypto world with this project crypto? So the winners definitely going to be the Wall Street custodians. We're basically opening the door even wider for BlackRock, Fidelity, JP Morgan, all these companies, ETF issuers, all the derivatives, all the Wall Street is going to be all over this. They've been asking for this forever, and they're going to put their twist on their normal twist on derivatives, on all these things. And they're there to collect fees. Whether the Bitcoin goes up or down, they don't care. They're going to make sure they're there to collect the fees whenever we do transactions. The big losers, I think, are going to be everyday investors, potentially pension funds or people that are retiring, long-term Bitcoin holders, even corporate treasuries like MicroStrategy might be affected by some of that, might be affected by some kind of reduction in volatility in Bitcoin and won't be able to make as much money as he was able to in the past. Just keep in mind that these two are connected in more ways than we think, and we're planning to connect them even more, connect more of that stock market and with the crypto, so there's going to be even more integration. The SEC definitely is moving forward, has green-lighted this crypto project, and it's great. I mean, I'm not saying it's not good, but don't ignore these risks. Don't believe for 1 second that Bitcoin it trades like gold or is like gold. It's not. It's if you look at the stock chart, if you look at the analysis that's being done, it is trading more closely with the stock market. So make sure you stay aware of that and be aware of all the connections that there are with institutional investors, pension plan, all these people that are investing more and more into Bitcoin and diversify. And you have Bitcoin treasuries also that are in the stock market, but they're really Bitcoin kind of derivative. So the truth is that Bitcoin isn't just decentralized anymore. That was the whole idea. But now it's just becoming a Wall Street asset, just like everything else. As you can see, the investment landscape is changing rapidly. The SEC is moving forward very fast, and so is the CFTC. There's more laws coming on board. There's more changes, tons more changes. All these changes are going to affect your financial future, so it's important to stay informed. Make sure you click the like button, subscribe to this channel, and see you next time.